And and also as well, like, I don't know if you've ever, how much time, I'm very rarely do working from home unless I'm dictated to that I need to be at home for something, in which case I'm definitely at home. But if you've ever done
wise
it,
choice.
well, yeah, definitely wise choice. My dad got through 4 divorces, and I'm not going to copy that. So
How many? 4?
4, unbelievable, wasn't it? I wouldn't need to be doing stuff like this if you just stuck with one.
Surely after the third time, you've got to call it a day.
Should have called it. I'm surprised it's not going around again, to be honest.
So it's maybe just like wedding cake.
Yeah.
I think that.
That's an expensive life.
That's a very expensive wedding cake.
Yeah.
Welcome to the Property Funder podcast. I'm here today with James McGregor. James is the Group Director of P10 Financial Group, and also with Jack Bristow, who is the Managing Director of J3 Advisory. How are we doing today, guys?
Very well, thank you.
Brand new.
Brand new. What's that? So James and Jack have both been on the show before. So having a bit of a redux, as it were. Jack was, I think, number 2 or number 3.
I was early,
very early. So I think you were in a hotel in Manchester while they were sort of doing the teas or something with the
slightly
amount of noise
unprepared, maybe a tiny bit hungover. Yeah, it was. We're better set here. So
yeah, I think that's perfect preparation for.
Did you show up
for
late
a
there as well?
podcast.
I didn't know. Well, I think I probably did actually. Yeah, because I think I was trying to find a room to be able to do it in, and I didn't know Michael as well then as well. So it was slightly more awkward than turning up a bit late today.
James, actually, to be fair, we actually did. You were one of our first ever off-site, in-person camera recordings that we did, like kind of semi-pro. I think that was pretty good, apart from the camera cutting out. So we lost about a third of the footage.
Semi-pro, I wouldn't go that far.
Yeah,
we had an iPhone recording it that ran out of battery, and we bought like a £500 set off Amazon to record it with. And that's the only time it got used. It's still in my garage now.
Then the iPhone ran out of battery. It ran out of storage.
Oh, right. No.
Which doesn't make it any better. But
too much suspect stuff on your phone.
anyway,
mate.
so now here we are. We're here in a professional studio, so we've got no excuses for not having the content. How things been since we last interviewed, James? What's the updates? Going from strength to strength, from what I could see.
How long ago was it? A year?
It was about nearly 2 years ago now.
2 years ago. At the time we'd just invested in Devonport's estate agent. They've just opened their third office now, which I think we've just sent a sort of mailer out today to update everyone on that. The business at the time, we'd probably doubled our headcount, I'd say. Or we was on the journey to doing that. We've reined that in a bit because, well, not reduced it, but we haven't gone on that growth trajectory because it was very expensive.
Yeah.
And we've just now managed cost, kept it steady, and then hopefully make a bit more profit this year, which usually what happens when you manage your cost base.
And you've seen some expansion across your various sort of what I call product lines, because you cover not just. Well, you've obviously got the investment in Devonport's, but the main business
the main business, just to clarify, we got a mortgage team, so residential mortgages. We've got our capital advisory team, so the debt advisory. We have an insurance arm, which is mainly like you're not sort of at this guy's level, but the sort of personal insurances, so protecting families. And then we've got the accounting and tax advisory, which I'd say a lot of the investment is going into there.
Yeah.
Takes a lot of upfront investment in people capital into that business for you to be able to bring on the excess work.
Yeah. And then you've been looking at wealth as well, wealth management?
Yeah. Wealth management, it's taken a bit longer to get there. We have a deal agreed, and that should be starting. It's meant to start in December, but it should be starting in March.
In March.
Officially. We're still advising clients through almost like an AR setup. But it will formally be a P10 Wealth division, own entity, own regulation.
Wow. Nice. Wow, that's really exciting. So the reason for the delay is that to get the regulatory approvals, or is it?
Yeah, look, so the way that business that we're working with at the moment is set up is an AR I don't agree with being ARs, as I think we've probably spoke on that last time.
Yeah.
Because it just creates friction in your business. You lose control. I've never understood why you have to pay money for nothing, really. So we're sort of trying to work around that and make sure we don't have to do it again in 2 years' time.
Yeah. Fair enough. So it's a bit of advanced planning, and so you take a bit more time to kind of get to where you want to get to. What about you, Jack? We obviously it's been a little bit longer, probably coming up to, I'm just going to say 3 years, but at least 2.5 years.
Yeah, 2.5, I think.
But I guess a lot has happened since then. When we were, at the time, I think you were in the middle of some litigation with some former business associates. Is that now under the bridge?
Yeah, we're under the bridge on that. Business is growing. Similar to James, I think no one's finding it particularly easy at the minute, I think. And the general notion that it takes longer and costs more money than you expect is probably a shared one around the table. But we've made some good progress on the lender side of the business with regards to helping them with insurance due diligence and advice. And we've really nailed our colours to the mast on larger schemes, on latent defects, which I think that we're well established sort of brand wise on that and alignment on that. So yeah, we're going reasonably well considering the conditions.
And in terms of the market, obviously it's a very different market in terms of the development world since we last sat down and spoke, or at least on the podcast. Obviously we've spoken more recently. One of the things that we're seeing as a feature, I say a feature, more of a bug in the market, particularly in London and larger schemes, which obviously is something you do a lot of, are issues around the BSR regulation, buildings over 18 metres tall, for example.
Yeah.
What impact's that having on activity from your clients, and then the knock-on effect in terms of the amount of business, the amount of policies that you're able to write?
Yeah, there's a few bits to unpick there. The appetite is there from insurers to support. That remains consistent. The problem is the bottleneck that everyone is featuring, where we've got this backlog, which is going to be cleared by Christmas, so we're going to be fine. So we've felt that, which has mean we've needed to pivot slightly on where our focus is, because when you pitch yourself as the guys that are going to be doing the large-scale schemes for the experienced developers, and all of a sudden they become a bit scarce, you need to make yourself busy in other areas. I think that that's also been felt by the insurers in the market. Those that would also peg themselves at the larger scale of schemes are looking and going, okay, well, for the time being, we need to be more in that SME space, which I think those deals are fairly scarce as well, because it's difficult for those deals to stack at the minute. But where they are there's quite a lot of competitive tension amongst insurers for that work, because it's dried up a little bit at the top end of the market. So that's definitely been part of the challenge with regards to where's the work coming from. There's less of it on the ground, but I think in a strange way, it's almost it flushes quite a lot of Johnny-come-lately developers out, and you really have only got the truly sort of experienced operators that can take action in this part of the market or this part of the cycle. And they're probably the ones that value good advice more so than chasing the price on, just doing the Dutch auction of who's going to drive the price down best. And you can go quite sensibly and have that conversation with them. And if you're pragmatic in your approach, they appreciate the good advice. You normally pick the work up, but there's definitely less work to go around, I would say.
How's that impacting your business, but also your competitors? Is that making, is that making the competition between other advisors in your space that bit more fierce?
I still feel as though we're small enough that it doesn't impact us that much. So we've got quite a lot of growth to go for sort of where the business is on its journey. That even though there is less work to go around, we're well positioned. We've got a super experienced team on the latent defects side that have got good networks and are trusted by lenders and other people in the ecosystem. And I think that's kind of the key to it. We took the decision probably when we did the podcast 2.5 years ago, that actually, whilst we do need to definitely be talking to developers and main contractors, there's loads of other people. No one's taking the unilateral decision on insurance anymore. Funders have got their piece, the monitoring surveyors do, there's various other people that are involved in that process, and you need to understand where the pressure points and the precipice is amongst the group, and make sure that you're delivering value, not just, oh, we can get you the policy, can we take a look at it? It's having the business acumen to be able to demonstrate what the pinch point is for the lender, what it is for the developer, what it is for the main contractor, and taking everyone on the journey and getting everyone the policy that they need, rather than the one that just the funder wants or just the developer wants, because that creates deal friction, slows down drawdowns, slows down everything getting started. So it's being able to take that position and say, actually, who's funding that? Right, okay, cool. We know what they'll ask for on that. And who's your main contractor, who we're appointing? Right, and what you're doing on the construction policy there. So I think that being able to ask more questions, 2 ears and 1 mouth, and use them in that ratio, I think if you do that, you probably separate yourself away from the rest of the brokers, because everyone wants to tell you how many policies they've placed and how wonderful they are at their job.
And you upset you upset one of the insurers recently, and they sent you a shirty letter. Is that right?
Yeah, I think that part of the job, I think the hardest job for anyone in the insurance space is to be on the sell side for an insurer, because you've only got one product to be able to sell. You've got your KPIs to hit. It isn't necessarily in your interests or in your manager's interest to say, actually, do you know what? You're better off going down the road to James, the insurer, because he's got a better fin policy for the scheme that you're doing. That's not really in our wheelhouse. As the intermediary, I think that we have that dexterity and can be fleet of foot to be able to do that, understand what the push and pulls are, and say, you're probably not in the right place here. We should go there. And in the latent defect space, as funders and developers will know, there's a number of providers that don't have rated capacity here in the UK, or don't have full access to the lender list from an exit perspective if you're going to be looking at selling on the open market. And those guys typically, they have their place in the market for sure, but the thing that they lead with, as they should do, is price. And I think that it's helping people understand that there's only a certain situation where that works. We're quite good at explaining the situations where you should be working with certain insurers, who has appetite for what types of projects. Even if they're telling you that they're the best one, I will always use the example that if we get all the insurers in a room and sit them around the table and say, we've got a 300 unit tower, a 500 unit housing scheme, and a pub conversion, who's best for each project? All the insurers will put their hands up. They're not all liars, but they can't all be telling the truth. And it's either your job as the developer and the funder to work that out, or it's the intermediaries to help you navigate it. And obviously, when you highlight certain points, some people get more upset than others.
So in that situation, is what has happened here is an insurer, you've basically been advising other insurers.
Yeah, lenders mainly, yeah.
And then not because their policy may not be, or they couldn't actually protect the risk for those lenders, right?
Yeah.
And then they've written to you about that.
Yes, I think that they were concerned that we were sort of hammering them or caning them and saying, don't buy your insurance from Michael Dean Insurance. When in reality,
don't buy insurance from Michael Dean.
No, we've played that game before. It's not great.
We'll get you anywhere. It's a fan.
No, definitely not. I'm not sure what the claims process is.
Zero.
Yeah,
pack up and leave.
But it was, there's a few facets to it. But simple things like the inner limit. You've got a £10 million bill cost. The inner limit of the policy is £1 million. Yeah. Just it's not fit for purpose. You're just okay. It's 30% cheaper, but you're buying a problem. Do we know what the claims process is like? Has anyone got any evidence of it? If you stress and ask those questions, what do you get back? And quite often they go and ask those questions and they're met with resistance. Okay, cool. I'm not really sure that's how we should be making decisions on insurance that way. So I can understand why people, if they can't answer those questions, they would be frustrated about it. And, we respond politely to those letters. But our job is to give the right advice to the client. And the advice is, if you can get A-rated support from lenders whose underwriters are based here in the UK and have got ratings and are compliant with FOS and the FCA, then you should. If you can't, then maybe you have to explore other ends of the market. But until you get to that point,
because the issue will be that if you're, obviously Avamore operating much more in the sort of SME end of the market, some of the schemes that you'll be insuring on the latent defect side, they're going to be hundreds of units.
Yeah.
At the end of the day, like if you built 9 flats or 6 houses or whatever, you want to know you can sell them, because the people that are buying the end users, essentially, they can get they can get mortgages on them. Not all mortgage lenders will accept the latent defects policies from what people might historically call an NHBC warranty. Obviously, NHBC is a brand in its own, but effectively you want to be CML, cancel mortgage lender compliant, so you can get out of them, right?
Yeah, exactly. And also making sure that the underwriter that sits behind the insurer, if they've got, no one can guarantee the solvency of an insurer, especially in this market. We can't guarantee the solvency of anyone apparently. But if they've got an A rating from Standard & Poor's or AM Best, then everyone is going to feel a little bit more comfortable. If they haven't got that, but the insurer down the road has, from the whole idea of the latent defect policy is to protect the consumer. So the developer needs to be taking decisions that has the best interest of the consumer at heart. Yes, we could buy it from these guys over here and it'd be 30% cheaper, but what's really the right thing for the consumer, and also allows you to realise the exit, which is a key motivation for you as a developer and also for you as the funder. And most people know that, they just need to be reminded. And if you're an insurer that is on the other side of that conversation, I can see why that's frustrating. But equally, I imagine those insurers, if they could get A-rated capacity, they'd be delighted to have it and they'd waive it.
But surely on the other side, shouldn't they just go after different business?
Yeah, and I think
wouldn't that be until you get to a stage where you're like, actually, I can operate in this market.
Yeah, I think that you have to horses for courses, right?
It'd be like Michael trying to write a £100 million loan at Avamore.
Yeah,
well, and as in one loan.
Yeah.
You'd
be like, well, it's not our market.
It's not our wheelhouse.
It's not. Very much not our market.
And that's
right?
why I'm a bit like.
Yeah. Well, I think sometimes as well the lack of education piece creates opportunity for some people. So they think, oh, well, actually, we could do maybe some of the more distressed assets, those 7 to 10 units. The lenders had to step in. They're going to need to get a new policy. We could put ourselves at the front of that queue and say nobody else can do it. And whether that's the truth or not, obviously, I would argue the fact that you can still get A-rated support for those situations. So I think it's one of those. In every market, there's good and bad, and depending on which lens you're looking through, will determine what you truly think.
So just as you thought your days of litigation were over, they come back. They come back for you.
A wise man told me that my challenges would appear in a different form, and that one was just a more similar one than I was used to. So yeah,
I wouldn't listen to that wise man.
What is this?
I wouldn't buy insurance for sure. So.
Yeah, I've heard that wise man is like a broken clock. He might be right twice a day, but most of the time he gets everything wrong.
He throws a lot of stuff at the wall for sure. Yeah.
But in terms of, we were talking off camera about, you and Fran, your partner, we're talking about actually you've been waiting for a kind of recession. I mean, whether or not we're in a technical recession, it certainly feels
10 years, haven't we?
It certainly feels like in that sort of southeast market that you're particularly strong in, James. That things aren't quite as buoyant maybe as they were a few years ago.
No, I think probably after Brexit, we probably had a challenge every year. But yeah, the conversation me and Fran have is like throw a recession and then the cream rises to the top. Right?
Yeah.
It creates opportunity, doesn't it?
Exactly.
I think that's what you have to adapt to each market. If we didn't have the Building Safety Act situation, then we'd all be piling into the tool schemes, and that's what everyone would be doing. A little bit like.
Do you think so though?
Well, not everyone.
Because I think the end user market's still quite weak, but I think the BSR stuff has just created even more of a. It's kind of for the developers. You're screwed in both directions, right? Because you can't. It's hard enough to sell them. You can just about get them away. Yeah. But then at the front, you can't even get started. You can't get them built.
Yeah. Well, I think that with regards to the opportunity that difficult markets create, everyone pre-COVID was a built-to-sell developer with a couple of anomalies on the BTR. But then as soon as interest rates, as soon as you come out of the Disneyland of interest rates and they go to a more normal level and slightly above normal level, and sales incentives for new build homes go away, so that market dries up, all developers become BTR developers, which is what we've seen a lot of, and which is why sort of the middle class now gets squeezed out, because you have BlackRock and everyone coming in and helping with that BTR position. I think that
someone get Jack a tinfoil hat.
Yeah. So, but that's I just think that as James says, it creates opportunity for everyone, and the developers are really good at adapting to market conditions. So that now everyone is doing it, and they're selling them as bulk to pension funds and everybody else, and doing forward fund deals where they can, because they can't sell on the open market, and that will turn around, and then everyone will go back to being built to sell developers.
Well, yeah, I guess we need help. We need a new Help to Buy, right? And then that will sort of sort that out.
Then who's help? I've always had this argument: who the hell Help to Buy was only helping the developer?
Well, I think what Help to Buy did was it essentially meant that the floor price for any unit in London was 600 grand.
Yeah, but who's paying that? Us as taxpayers.
Well, and then
you
can make it in some way. Yeah,
who's pointing out that developer? So actually, what needs to be?
Is it even the developer? It's probably landowners and funders,
exactly. No? Yeah. It's probably not even but it's ultimately not the people buying the properties.
No, it was a stimulant for the rest of the market, wasn't it, to keep it all moving? Like it was to allow the music to keep playing as much as anything else. So.
Like really, what we probably need is build cost managed, inflationary pressures to come back, invest in oil again, like stuff like this. Not like we need to build more houses. Well, there's loads of empty gaffs already knocking about.
There's the government's £1.5 million. Well, we the three of us all understand the challenges behind that, right? This $1.5 million housing figure in the parliament, anyone in the industry with half a brain is like, that's never going to happen, because there's so many things that get in the way of that, of building any house, let alone 300,000 a year.
You can't build. Where's it feasible to build now? Your exit point needs to be like £800-900 a foot. Because by the time you bought the land and paid $350 a foot for the build, no matter what anyone says, no one's building at 200.
Well, I mean, it's interesting. It's interesting hearing you say that. Certainly, if you're dealing as we do in the sort of, let's call it the sub 10 unit space, on average, obviously we do bigger, but you do have people who are able to build reasonably effectively under 200 quid a foot, like 150 even as a hard build cost, is not unheard of. But in the southeast, no, that's a different story. And I think that's the difficulty, is that the market outside of the southeast right now. I mean, Avamore's had a reputation of being very London and southeast centric. I'd say that's very much turned on its head in the last couple of years, where actually the viability of schemes, for a couple of reasons. One, because the build costs are more, land prices are lower. Land prices are in some cases or next to nothing. Build costs are more achievable, and because the end units are more affordable, that you've probably got a more reliable exit market,
more liquid exit.
And then you throw into the mix as well yields. If they're being rented out, yields are a bit more viable. And then maybe HMOs as another layer that goes on that. It is a bit. It has created a dynamic where outside of London, the southeast now is performing much better for us, and probably all other developers in the space. But just taking it back to differentiation, because obviously we're actually on course at the moment for a record year as far as we're concerned. And I think one of our observations is that there are just fewer people even financing developments, particularly speculative. Is that something you're seeing, James?
Yeah. You've got a new bridging lender coming to the market every week.
Yeah.
Like, we do fast, we do this, but actual developments, the people that have the capability to deliver them. And then especially then you go probably 2 to 20 million.
Yeah.
In that space, the pooling gets smaller.
Yeah.
And then 20 million plus, the pooling's even smaller.
Yeah.
So it is washing out a lot of those sort of half operators.
I sort of feel like a lot of the development lenders that were sort of half-heartedly in the development market have gone very much bridge and refurb.
Well, yeah, they've just realised how flipping hard it is to develop. I think they've probably there's a lot of lenders out there at the minute with quite a lot of terrible loan books where they've lent out money that they probably shouldn't have. And then I can imagine a lot of funding lines have been like, well, what have you lot been up to in this space? Why have you been doing that? And that's probably just caused them to be like, well, let's focus on core.
And there's a lender that I think you both know, that the the rumours that we hear are that they launched. Their launch was Goldilocks in a way, but also in a good way and a bad way. They sort of launched with a 300 odd million quid to deploy in sort of 22, 23. Their cost of capital, because of where it's from, they were able to undercut the market. But I think the problem is if you're deploying in 22 and 23, the vintage of loans that you've got is going to be, and especially if you're pushing leverage as well, the vintage of loans that you're going to have is going to be really poor. And they're now in a position where they can't raise any new money to lend, and then any new origination has to come from exits effectively. And they're finding exiting a lot of the stuff that they've funded really difficult.
Well, I think everyone is, let's be honest. I mean, if you have every lender that looks across their loan book probably for the last 3 years, I'd imagine there's 90% that didn't fully exit in their timescale.
Yeah, I mean, I'll be honest, James, that's normal anyway.
Yeah.
That would have been normal in a good market.
Yes, but it's like, and what we've sort of now do is we underwrite with that, and we then underwrite the exit options for the client. So you're like, right, actually, realistically, you think you're going to get X away. Well, if we've only got Y away, where are we left?
Yeah.
And how does that impact you guys and the position that you're in? And then what you're then looking at is the lenders that are working with the clients to actually help them through that process, because there's two lenders in this market. There's the lenders that are actually working with the client and helping them get exits and giving them time and maybe releasing some sort of cost overrun when needed or X, Y, Z. And then you've got people just throwing them to the receivers and just obtaining equity off these developers that
I think the reality is they're probably not, a lot of the time, if the minute that you appoint a receiver, especially if it's part bill, you're probably not seeing, you're probably having to take a haircut on your position ultimately. That might include capital as well. I mean, I think everyone takes a little bit of a haircut on the odd bit of interest here and there. But actual capital haircuts is definitely a potential. I mean, you must see it, Jack, with you're obviously going to be quoting on a lot of part built stuff on the other side of it. But one of the reasons we'll almost never sell. We're not selling anything that's gone into default or via receiver is because we know that we're going to take a massive bath on our position, and so we're finding ourselves in positions where we have to work with a developer, or we have to find a joint venture partner to deliver it for us.
Yeah, bring it out.
Yeah, we see quite a lot of that from the lender space where they get left with these assets, and sometimes I think that it's not always the lender's decision that they step in. Sometimes they're left with no other option apart from stepping in, and then they're there, and the workout teams are kind of going, what do we do with this? And insurance is part of that puzzle, which we've helped navigate. But I think what a lot of your peers are all conscious of when they're in that situation is that they're the only ones. And whilst we're sensitive, obviously, we don't talk about one lender with another, we have definitely offered comfort to plenty of them that a lot of their peers that they think that they compete with closely have had the same conversation with us and probably plenty of others around the same way. So I think that there's, you talk about those vintage years not being so great of 22, 23. I think that a lot of those are being flushed through at the moment and having to be worked out. But it's in a lot of instances, we're getting engaged earlier on what look like problem loans before they go wrong, and what are options here, and how can we try and help the developer move it on, and at what point does this get to mission critical on the insurance where new policies are going to be needed. So I think before we were getting involved at a much later stage, and where some lenders have done that and they've realised that they end up taking quite a big bath when they appoint and going down that route and exploring that strategy. They're getting all of the consultants involved, or the advisors involved a little bit earlier and a little bit quicker to see if they can find a prevention route rather than cure. But there's definitely plenty of lenders out there that have got some tricky situations to navigate.
In terms of the advisory market, are you seeing stress or pressure in some of your peers in terms of some, because there's less work going around? Is some of them having to make cuts to headcount or or even shutting down? Is that something that you're witnessing at all?
I think from what I've seen, insurance broker wise, it doesn't seem to have been too much of an impact. I think that there are some quiet cullings that have had, and there probably were some chunkier teams that have been trimmed and streamlined down. And as James said, cream rises in these situations. I think that the interesting thing that we have seen is lots of finance brokers starting their insurance divisions, which I think is a natural bit of progress. They've seen other people do it. We've obviously done it the other way, where we're heavier on the insurance side than finance, and people thought, we weren't the first to do it. I mean, Howden's buying SPF were probably the first. That was after we started. But there's that tie-ups happen. So I think people are finding, you talked about other opportunities and product lines that you enter into. I think that's also a bit indicative. People will say it's because they're entrepreneurial, but it's also because they're going, well, actually, there's less deals to be funded, there's less deals to be insured. Where else could we keep ourselves involved, deliver value to the client, and then maybe get another bite of the cherry to supplement that revenue, but maybe call it growth?
Yeah. How do you, have you had your eye on any areas of, additional product lines or product areas where you could expand into it?
I think that sometimes I get pretty shiny thing syndrome, again, which is another wise man quote. There are some obvious ones for us with regards to legal indemnities, which seems a sensible move for us next. We've had really good success on the construction and real estate insurance piece, where we've got a joint venture with the guys that we're in an office with now, and have been doing that for kind of the last 2 years. That's been really successful. One of the things when we were going in and talking to lenders, we were then getting asked about construction policies as well, which we've only really got superficial skin deep knowledge on. So being able to have those guys on hand and to team up and present as a united front to lenders on that has created more opportunities and more conversations. And also the same with developers in the same fashion as well, where I think when you deal with something like a specialist risk like latent defects, people will then say to you, what do you think about do you do constructional risk as well? And actually, we've got this site's coming to an end, we're going to retain it, can you do the buildings insurance? And I think it leads to sort of fairly natural flows into for us. So we've some of it was by design, but some of it is you're sat across the table and you go, that's the third time that's happened this week, we should probably do something about that. So I'd like to say it's because Johnny and I are masterminds on that front, but I think we just do what's in front of us a lot of the time and just try not to get too distracted by too many things at once.
So find a solution.
That's
a problem.
Yeah, exactly. Well, that's the job, right? It starts off with, I can introduce you to so-and-so.
Yeah.
And then actually maybe so-and-so lets you down, and then you're kind of like, right, I need to know more about that so I can ask more, get a bit further into it, and then give it to somebody a bit more packaged. And then before you know it, you're doing half of it and you're like, right, okay, fine, there's something in this, let's work our way through.
I think the hardest thing with that what Jack just explained there was basically how our whole business model started.
Yeah.
Referring work to people, they'll shit at it. We was like, well.
And we talked about it with insurance, didn't we? Where when you obviously had the historic insurance tie-up and they didn't do latent defects, and I vividly remember you saying to me, as only you can, the thing is with you lot as insurers, I think is what you meant, insurance brokers, is you don't do all of it. You'll sub it out to somebody else and somewhere else. And that often, Johnny and I have talked about that a lot, where I think as well, especially if you're working on those larger schemes, I don't want to be subbing the work out to somebody that maybe I do know well.
No,
I want to keep it in how you can't control it. And we are particular about the way that we communicate and how we treat people. And I think that most things lead back is communication or skill, right? We have skill in reasonable abundance there, but how we communicate is probably the biggest differentiator. So we want to be able to control that as much as possible. And what we found with Alex and Jordan, who are the two guys we've got the JV with, is that we're on similar pathways, journeys, although their background is different. They've got super strong underwriting credentials rather than broking, which is good because that does underscore Johnny and I a little bit.
Them up a bit.
Yeah. So
gives you a bit of value.
Yeah. So guys, what I've said is we can do this. If you could just find a way to do it, that'd be great. So I think
I've promised it. So can you just make it happen?
Yeah. So I've got a problem. I made it bigger, and I'm going to give it to you. I think those are the crossover points.
This podcast is sponsored by Avamore Capital. Avamore Capital is a development and bridging lender based in London, but lending all over England and Wales, lending on projects from £250,000 all the way up to £25 million on bridging, development, refurb and part complete developments. Please visit www.avamorecapital.com to find out more. I think when we were chatting the last time, the M&A market for all professional services, but particularly for insurance brokerages, was quite hot. You're sort of still painting a picture that there's a lot of rationale to have more insurance lines under one roof, but by the same token, I'm not sure that the money, the private equity money, is quite there in the way it was. How do you square that circle? And is M&A something that you're thinking about in your mind, Jack?
I think it's, from our perspective, we look at things, the JP we've got in construction and real estate, and one of the things that James and I talk about, where we're similar in age, and although P10's been going nearly twice as long as J3, is the journey's not dissimilar time-wise. And I think if you've got some shared principles and you're tracking the same kind of way, then it makes sense to find ways to do stuff together, because you can better serve a client, which is what you guys have done with accountancy and all the other bits and pieces that are involved, and the same with us, construction insurance. The people that I know that have been involved in M&A and they've been consolidated, I would say are mostly the most unhappy people I know of my sort of peer group that are there. So I think that the one-off payday is probably great that day it hits the account, and brilliant for the ego, and definitely 150 likes plus on LinkedIn. I'm delighted for them, but I'm not sure it goes much further than that. And I think that the being the outlier in the situation is being privately owned and not having big American money or wherever people decide to source the PE from, is a point of difference. And actually, for a lot of the market that we serve and we deal with, you're dealing with a business owner. And as much as it's nice to get an email from the assistant vice president and the team making at one of the big brokers, I think that what a lot of them appreciate is business acumen, which does cascade down with more junior members of staff. But it's people that are also trading in the same market where the conditions are difficult, and they're trying to run a business, we're trying to run a business, and you can have that pragmatic, open conversation with them, be that about a policy, but you can make it more relatable, rather than the guys that have been consolidated and they've got to hit that number, and the decisions are kind of taken out of their hands. So, like most things, it has its place in the market, but I'm not sure that it's not on our vision board at the minute for somebody to come and get us.
Well, just staying on the subject of M&A, because I know we've talked about it as well, James, with you, but we had Stu Hicks from on podcast. I think the episode was out last week, wasn't it, Davina? And I recorded it a couple of weeks ago. I think he made a really interesting. He was on with Dan Greenhouse, so a pair of them, a couple of recruiters. But Stu and his wife also have a business that does sort of M&A advisory as well in financial services. And he made a really interesting observation I never really thought about, which is that a lot of specialist finance business owners, I suppose, by extent, obviously, James, that certainly applies to you, but by extension, Jack, you are a specialist finance business of sorts, even if you're more on the insurance end of it. Yeah. The observation was that most of the founders and leaders of the businesses are just too young, and so don't have that motivation and desire to go and exit, because like you said, there's that one-off payday, but then you have to think about, well, what comes next. Is that something that is that sort of resonate with you, James?
Yeah, I've gone through these thought processes. Sometimes exit, sometimes no. Probably depends on the month you've had.
Definitely, yeah.
But I think, I don't know if I'd agree with that, because most people in the industry, I'd say, knocking on a bit, the leaders. There's a few standout people who are similar to us.
But do you think you mean more on the brokerage side, you think?
Yeah, but I don't think there's any value. That's why people can't exit.
I still don't. I mean, let's debate that, right? Why? I don't know why. Still don't understand why people undervalue, particularly brokerage, like finance brokerages, in the sense that yes, you have yes, the individual transactions are, quote unquote one-offs for the most part. I mean, it's different for resi, but ultimately, the value is in the client base. No.
Yeah, but the problem is the expertise is with a lot of the senior people, and the senior people hold the relationships with the bigger clients.
People don't often talk about the brokerage that they use. They talk about an individual within a brokerage. And people, if you ask certain people, like, oh, who do you get your debt from? They won't, and I'm sure some do, but they won't necessarily talk about P10. They'll talk about James. Or some people say, oh, where'd you get your? I can't imagine anyone asking them where they get their warranties from. They're unlikely to say J3. They say, oh, Johnny does it for us. Johnny at J3.
Oh,
so yeah. I think that's where sometimes the lack of value is, because unless you've got those people tied in, obviously in all of those situations they would be, but that does thin out as you get further down the team.
You can't predict cash flow. There's too many third parties involved for origination. It's very hard to control that. It's the actual business model is probably quite a terrible one, if we're going to be completely blunt about it. There's the barrier to entry is so low that, like, the only reason the really good people in the industry write a lot of business is because they're extremely skilled at understanding how debt works and understanding valuations and understanding everything that goes into it. And you'll find at all the big firms, I guarantee all the big players, all the biggest writers in that firm, they're still writing their own deals.
Yeah, there's a couple of things. There's a couple of things to unpack there. The first one for me is that I think the rise of technology, but AI in particular.
Yeah. I'm with you on that.
I think that a lot of that know-how that you talk about,
you can teach it.
And it can be replicated.
Yeah, agreed.
And then for me, I think that in lots of ways, the broking will become, I think, even more advanced broking that you're obviously doing a lot of, James. I say advanced, but in terms of complex transactions, high net worth, high value. I think that at the moment it's not massively commoditized. I think it's going to become increasingly easy to commoditize. And I think that the experiences and outcomes are going to become a lot more. And I say that because with the technology we're developing, right, we're trying to create a consistent experience, consistent experience first, and then consistent outcomes.
Yeah.
If you can, by extension, kind of, what we do becomes commoditized, which means that the products you're offering also become much more commoditized. So as a consequence, the experiences will become largely the same, and then it's just a question of
how big's your marketing spend?
Yeah, how big's and also the point you make is right, Jack, which is that yes, at the moment it's I want Jack, or I want Johnny, or I want James, or I want Fran, or right. And look, by the way, if I want a resi mortgage or I want a commercial mortgage, I'm calling James and calling Fran, right? If I want a LDI policy, I'm calling you, right? That goes without saying. But I think that we are probably at the very start of a shift, where a lot of that advice will become more commoditized, and actually the value in what you guys do, for me, as I see it, just with a sort of entrepreneurial hat, investor hat on, it's like the value is actually in the relationships as a sort of lead generator for other products and services, right? That's why I feel like the prices that people are most likely willing to pay for a brokerage, they're never going to be a 10x. It's never, for finance brokers, it's never going to be a 10x business, right, in terms of the multiple. But it's probably not the 2 or 3x that people might be offering you. It's probably like a 4 or a 5. And I think that it's just a little bit undervalued in the way I see it.
I think with that though, the technology needs to be built, which is weird you've just brought out, because we've literally just put a scope of works out to do exactly what you said. So you're probably using technology for when the application comes in. Our biggest process is at the front end.
It's the fact find.
Gathering all the data, fact find, underwriting it, contacting all the relevant parties. So we're trying to build a front end process that takes away all that.
Yeah.
So ultimately, the idea is, Michael, this is what you need. Yeah, bang. By the way, here, connect to this. We'll go pull it all. We've underwritten it. Here's our solutions. Do you want us to crack on? And that's what we're sort of trying to get to. And then one of the things as well is we're trying to build as a 5-minute mortgage. So similar on the resi side. You speak, oh, this is what I need. Yeah, perfect. Okay, connect to here. Bang. Pull everything, Experian, land registry, XYZ. All right, we've underwritten it. We've done your affordability. We've tested it across 10 lenders. We've sourced it. We've come back to you and said, here's the best product in the market. Here's your suitability report.
To be honest with you, I mean, it sounds really fascinating, especially, and I know how achievable that is as well, just because of, you know,
what you guys
what we've built.
Yeah.
I mean, we've probably done a lot more on the front end, than people realise. But you know, it's like, you know, if you've got that open, like access to open banking and be able to connect into that side of things, you know. I guess on your side, right, especially as I can speak to it as a consumer, right, which is that as a consumer, I know how much of a pain in the arse it is to go and get your KYC and your bank statements and, all right, update your A&L.
It's
and this,
painful, right?
Very painful. So I guess the number one thing you're trying to achieve there is reduce the friction, basically reduce the amount of ball ache that, or other appendage if you don't possess
for
that.
the end user, for the client. It's like, actually, how do we make this so easy for our clients to deal with us that every time it is, we can just spend more time actually talking to them about what we're doing rather than.
And let's be frank, it really should not take on a standard resi mortgage more than 5 minutes.
No.
I mean,
there's no reason.
In fact, it probably can and should be instant.
Well, like lenders have been issuing offers, full mortgage offers in like minutes for about 10 years now. We've almost gone backwards. Like when we first started, we was going like every high street lender, you go bang, submit, offer, here you go. So then we've gone through this whole, like, the technology's got way better, and then we've gone backwards with it. Doesn't even make sense.
Well, I think the prime example of that is on the legal side, right? Which is that it almost feels like when you work with lawyers, it doesn't feel like, in a world where everyone is massively leveraging technology, it doesn't feel like lawyers are on board with that. Probably because they know the technology is about to eat their lunch in a big way.
Well, but is it though? Because it'd be the same as every broker's probably should have their lunch eaten by technology as well. Why do you need me if you can put it in, say this is what I want to do, the system comes back to you and tells you exactly what the best options are in 3-4 minutes. Well, and then you can click a button, go straight to the lender, bang, where are we?
I think right now, you know, I've always likened, you know, the role of a broker, particularly in, say, the bridging and development world. It's a bit like when you go to a high-end fancy restaurant, right? And you go and you say, oh, I'd like some, you know, would you like to choose some wine? And you go, and then they hand you, you know, the menu for the food is, you know, you've got a choice of three mains, 3 starters and 3 desserts, right? Or whatever. But then you get handed a wine list, which is, you know, thickness of the Bible, and you go, right, and that's where you need your sommelier to say, right, well, this is what's going to pair well. You say, right, well, I don't want to spend that much, and they'll, you know, and so on and so forth. So I feel like you know, a commercial mortgage broker or even a residential mortgage broker is acting, and it's probably not also not that, especially probably
the same in insurance,
exactly the same with LDIs. Is it, you know, you're acting like that sort of finance or the insurance sommelier?
Yeah, I think so. I think that with latent defects, we were talking about it when I was on the way here. James and I were having a bit of back and forth. He was being very nasty, and I was
you showed up flipping 20 minutes.
I was explaining that where you've got a small amount of insurers in that space, you lack a bit of competitive tension. It's not as if people don't know where they're going to be getting the warranties from. It's how you access it, it's how you leverage it, and everything else. Some of that can be done by technology, and depending on who the insurer is, we'll always say their biggest upside is that they're a technology-led business, but their downside is they're a technology-led business. And the same thing with their biggest competitor, who are people first, less technology. It's their upside and their downside. It's the balance between the two. I think with the mortgage brokers, your standard resi mortgage that you're going to take, I'm going to take, you're going to take, is going to go that way. The 5-minute mortgage. I think with the specialist finance and specialist risk on insurance,
and also the lenders don't want us in the middle.
No,
we've taken so much market share.
On the resi.
On the resi,
side.
on the resi side. Sorry, on the specialists, on the complex like commercial or development or bridging, we play quite a big role in.
Yeah.
But on the resi side, like we run a resi brokerage. Lenders do not want us, no matter what they come out and say. I will not. If they could cut us out, they would cut us out in a heart. And with the regulation about to relax on, which they're just about to bring in on that, they'll do all their best.
Is this because the banks will start to be able to? They'll be able to sort of provide a bit more in-house advice. Is it?
Well, it will be non-advised.
Right. Okay.
So then they're going to allow clients to execute. So then all they need to do is offer them an offer.
That doesn't, in the more high net worth, higher value space that you serve, doesn't that, even on the regulated resi side, doesn't that give you a bit of an advantage? Whereas, Bob in Hull.
Yeah, of course. Like ultimately, what really I believe will happen is like transactions where people are borrowing over £1 million, they'll want to talk to someone. And then transactions probably under that, where they don't want to talk to it, and people have grown up with technology, they'll just like, no, crack on, let me do it. So really what you need to do is build a platform that allows you to commoditize
you need to be able to do both,
ones.
don't you?
Yeah.
You need to have the churn of being able to do that,
and
as
then
well
you
as the specialist advice.
And then you build in a process that connects that chain if they need to speak to someone.
Doesn't the likes of Habito kind of already cover that, or
they're just a standard brokerage.
Okay.
Why do you think they burnt through so much money?
Right.
They basically set up a Google pay-per-click campaign, burnt through a shitload of VC money, and then realised they needed people. That's basically what happened. And then Yin got to buy them for a nice deal, I guess. So fair play.
Yeah, fair play. Changing gears slightly, James, you were talking a good game about the commercial property market. A lot of demand from investors going into that.
Yeah, well, yeah. I mean, look, I've always been quite buoyant on the office market, even though it's been doomsday, as they've been saying for the last few years. And yeah, obviously valuations have collapsed throughout, but I believe we hit the bottom a little while back. And it's now showing in central London. In city, you can't get space. West End, space is like £100 a foot, 120 a foot for not even the greatest spec of offices.
I think you're getting like 250 a foot in like.
That's what I'm on about like real like just dark dingy room, sort of like you don't want to spend any money on it sort of space. So and then all that will happen is that just feeds out, just as it did before.
Yeah.
Like people still, every business now is like, no, we need an office. We can't operate without one. We need people together. It drives collaboration. It drives growth.
Shareholders aren't getting paid what they used to, so you better get back to the office.
Yeah.
That's the big driver, isn't it? That's where that's.
Well, everyone's looking at their bottom line and thinking, I'll tell you what used to work really well was when we all worked together and we could get shit done.
And and also as well, like, I don't know if you've ever, how much time I'm very rarely do working from home unless I'm dictated to that I need to be at home for something, in which case I'm definitely at home. But if you've ever done
wise
it,
choice.
well, yeah, definitely wise choice. My dad got through 4 divorces, and I'm not going to copy that. So
How many? 4?
4, unbelievable, isn't it? I wouldn't need to be doing stuff like this if you just stuck with one.
Surely after the third time, you've got to call it a day.
I'm surprised I'm going around again, to be honest. So
maybe just like a wedding cake.
Yeah.
I think that.
That's an expensive life.
That's a very expensive wedding cake.
Yeah.
loves a stag do.
Jesus.
Yeah.
But if you're ever working from home and you nip down to the shops, or I've done it and gone to the gym near home, it's packed. And that wouldn't have been the case during the week. You think of like your Virgin Actives, your David Lloyd's. I mean, you've got lots of people now that will work from there as well. Sort of the one-man bands, rather than having a Ned membership and coming into town, they'll pay for David Lloyd and do it that way. But you're looking at it, and the one time I went, middle of the week, and everywhere's packed out. And you think, well, this can't be good for productivity. And then as time has passed, all the things that you've talked about, where people are getting driven back into the office,
It's thinning out.
Yeah, it's thinning out. Like, just because that's where the demand is. It's what the businesses require. It's what the economy needs. So
it's quite timely, because I know we've gone a little bit viral occasionally on some discussions, particularly Callum Taylor talking about working from home versus working from the office. But quite timely in the sense that I was watching just a short clip on X by one of the journalists at City AM, and they were saying that banks, particularly city or central London banks, are struggling to retain their Gen Z staff, because and one of the key drivers behind that is that the Gen Z, that they're, I suppose what I call older Gen Z, so people sort of in their late 20s, because they started their careers during COVID. The move from working from home, which was kind of what they were sort of baptized in, and then now being asked to come back to the office almost full time, I think that shift in culture is actually something that they don't want. And they also, I guess as well, working from home versus working in a big office, especially if you're in one of the big Canary Wharf towers, it doesn't feel very startup-y. So a lot of them are wanting to go and work in a more startup-y environment. Now, maybe that benefits businesses like ours. But certainly it does speak to that there is it's still quite an interesting challenge that that we as employers have to deal with.
I think you're seeing the reverse of the power shift dynamic now, though.
Yeah.
Because through when there was a lack of talent, everyone needed talent, that went. And now a lot of businesses are not hitting where they should be, and a lot of businesses are struggling, and inflation's ravaged everyone, and interest rates have eaten out of everyone's profits. You're now seeing the return back to the power of the employer.
Yeah.
Like, if you post any graduate role now, how many thousands of applicants are you going to get? Like, that is across every business.
When I think and that kind of fits with the M&A thing that we were talking about earlier, the M&A deals that got done during COVID, especially in the first 18 months, talk about vintage of deals. It would be great to have a look at some of the vintage of some of those acquisitions that were made then. And there were some scenarios where some of the bigger firms had gone in and done team moves, or they'd gone and got what was perceived as top talent or up and coming talent, and overpaid for it. And like one of the M&A conversations that I'd had a long time ago, we were talking about sort of some of the existing team and part of the team move that had come across from one to the other. And the MD of that business was explaining it to me. He said, we ended up paying X, Y, and Z, and it was not criminal amounts of money, but it was a lot of money for junior mid-level staff. But that was where the market was, right? There was a talent shortage, and everyone went flying into it.
Had loads of free money to throw at them.
Yeah, well, that was it. Yeah, that helped.
Do you know what I mean?
And
as soon as that disappears, oh shit, we need to make a profit out of these people.
Yeah, and I think you're sort of seeing the turn on that, along with the other points that you raise.
And I would argue as well that those people that have been at home won't have the same skill set as if they've all been working together.
Yeah.
We can't develop at the same rate, can you?
Who the hell are you learning from?
Yeah.
What, you're in an investment banker role and you've been working on your laptop for 4 years, and you're telling me that person is as skilled as the previous 5 years who started in 2015, who had been with the senior bankers, who had showed them how to analyse deals, to do everything in that skill set. There's no way they've learned much. First of all, the people skill set they would need, they won't have.
It's the communication thing,
That's
isn't
what I
it?
mean.
That's what I always think about. Like, I could do with spending. We've got 2 junior guys that have joined us in the last couple of months, and I think I'm spending too much time out of the office at the minute, whilst there's stuff going on and there's transactions happening, and they're plugging into calls and listening to conversations and having their own. Where I've always benefited is working across the table from the CEO
guys,
or whoever else, and Johnny and I are pretty good at, if one of us is not there, the other one is. So that's still happening. And I think about the people that say, when you're doing the interview process, what's the working from home situation?
Well, it's not working here.
That's a straight red flag, isn't it?
Yeah.
So it's working at home on your own, mate.
Yeah,
That's what it is.
A lot of the time they're taking advice from, mum and dad who are at that point of their career where they've got flexibility because they're in their 50s if they're still in employment, and they've got the flexibility. You want to get a couple of days at home, you know, that balance. It's not what you want. Like, you want to be in it and around it and living and breathing it, because that's what expedites your development and your journey. But it's quite difficult if somebody hasn't got that mentality from mum and dad and at home. You can't give it to them in an interview. You're just kind of like, all right. And you can see why so many young people struggle to get into roles as well, because whilst you get hundreds of applications, I think you know super early on junior hires whether they've got the right principles and you know core skills that you look for these sorts of roles.
We just hired a new like web developer, so we've got three in total, and one of the requirements is that they have to be in the office. I say full time, but you know, full time by our standards, which is 4 days a week plus maybe the occasional Friday. And you know, actually, the pool of the minute particularly for that type of role, the minute you say it's not hybrid or not a remote working role, you basically you go from what was a very deep pool of candidates to a really shallow one, and then added to that, you're then trying to find someone with the right sort of interpersonal skills, you know, which
probably
is
tough in the web development space.
Well, you said it, not me. But I thank you for it.
I can feel it on your face.
I mean, it doesn't lend itself to people who are particularly outgoing and vivacious. But so you're narrowing it even further. But it just goes to show that it is difficult. It is difficult to hire right now for that kind of role. But like you said, James, like the dynamic, that power dynamic, it felt like it was very much in the employee hands for a very long period of time. It's slowly going back in the employer's direction. Do you also think, though, that there's that cultural component to it as well, and there's business pressures, but do you also think that the adoption of technology is also, like for a lot of those Gen Z folks, who are maybe struggling to get on in their careers, do you think also that at the technological developments, meaning that the more experienced, more capable people can leverage their technology to make their own skill sets go further? Does that mean that also that's another reason why candidates or younger workers are struggling to get on in their careers?
I think the bigger problem for the much younger, like the grads now, maybe the first jobbers going looking for that second job, is that in a lot of instances what they're looking at online all the time means that they're seeing lots of instant gratification. So the thought of going and working at a place or a couple of places for 4 to 6 years and learning your craft, well, actually I want to do my own thing now. I think I'm entrepreneurial, so I'm going to be an entrepreneur and I'm going to go and do my own thing. I think that's a big. I think that the technology is a point, but I think it's secondary to the fact that actually finding the people that want to go and do the grunt work and maybe leverage technology along the way. There's a lack of grit as a starting point. I think from the talent, from the most junior level of it, and then that compounds when you add in the technology point.
What do you think, James?
I was just trying to. I don't know. It's just a tough one. Like, I want to come back to what Jack said earlier. The actual learning on the opposite side. I literally had a conversation with Fran today. I said, "Look, we need 3 juniors." I'm like, right, okay. If we sort out 3 juniors, everyone needs to be in the office 5 days a week. No matter what their technology is, no matter what that, because
they need training.
They need to understand what the hell we're doing. Because to come in, and it's not about just understanding a job. It's like Jack said, it's how do you communicate with people? How do you go on your meetings? Who do you need to call when you need shit done? Like, it's all of this that technology's not giving you that. No. Especially in our industry. We're actually quite an old school industry, right?
Yeah, I think that's entirely right. There's the technical how to do the job, but it's not just the kind of LTVs, LTCs.
How many times have you told your get on the fucking phone?
Yeah.
Do you know what? Like, the most simple thing. Yeah. Get on the phone and sort it out.
Yeah.
Well, anyone in this chain will do.
Yeah. When you go, I've sent him an email.
No, call them, call their boss, call anyone you can, and try and get this done.
I think you just demonstrated why we still need mortgage brokers today.
Yeah. I get that.
Right, on that bombshell, I think we're out of time, aren't we, Davina? Yeah. So, anyway, chaps, really great to have you both back in on the podcast. It won't be the last time, hopefully. So thanks again. If people want to find you on the internet, what's the best way to reach out to you? James, start with you.
P10 Financial Group on LinkedIn, Instagram, across all the socials.
Nice. And what about you, Jack?
J3 Advisory, LinkedIn, Instagram. Instagram not used that much really, the odd side visit, but LinkedIn is fairly prolific, so that's the best place.
Nice. And I've been Michael Dean. You can find me on the internet at property_funder. Thanks again, as always, to Avamore Capital for their ongoing sponsorship and support. Thanks again to Davina for producing today's episode.
Thanks, Davina.
And we will talk to you again on the next one. Thanks, and bye-bye.